Compared to traditional financial investment opportunities, crypto is a very fast-paced world. And although every single crypto investor believes firmly in the future of decentralized finance, their trading strategies might indicate a vastly contradictory mentality. As with any means of investing, it's important to have some form of strategy. Investing purely off emotions is seriously inadvisable. Looking for hints or indications of where the valuation of a potential asset might swing is certainly recommended. If you feel clueless and seriously underprepared, do not worry. You've come to us at the right time. Welcome to No Cap Crypto. We've got an interesting lesson planned for you today. The collection of strategies and investment plans we've assembled covers some pretty complicated concepts, so do pay attention and make sure you stick around till the end. It's important to get the full story. We've also included a number of highly complicated concepts but attempted to simplify them for you newer investors out there. There are multiple facets to any trading strategy, from selecting a target to selecting when to buy and when to sell. These are all often dictated by the mentality of the trader. Aggressive and bullish traders will see the smallest indication and extrapolate them, as opposed to the more conservative and long-term traders that look for sustained and healthy growth. A good trader generally walks the line between these two vastly different extremes. When looking to structure a reliable and quality investment strategy, it's often recommended to maintain a rigid and firm backbone. Don't avoid risky and volatile assets from smaller companies, but focus a large portion of your overall trades around a core, big-name market mover. A holding of Bitcoin or Ethereum, for example. Bitcoin is a fantastic major asset to structure any type of decentralized portfolio around, due to the currency maintaining the status of a market mover. The performance of Bitcoin has always been echoed throughout the rest of crypto. Bitcoin rising will bring out the most of the market alongside it. Bitcoin dipping is often the earliest signs of a bearish marketplace. Regardless of its volatility, BTC is considered a safe investment across crypto. It's digital gold. Although nowhere near as reliable as a stablecoin, when the market dips, holding BTC is your safest bet. Some altcoin projects will never survive a crypto winter. This flow in and out of Bitcoin in relation to altcoins is somewhat cyclical in nature. Investors will either go safe with BTC or go aggressive and innovative with smaller, riskier, and more exciting projects. However, this relationship is a great indicator for many quality trading strategies, referring to as Bitcoin dominance. This metric compares to the total decentralized marketplace and the percentage which is held in Bitcoin. A lower dominance would indicate money flowing out of BTC into altcoins and vice versa. Compare this BTC dominance with the total cryptocurrency market cap. The overall cryptocurrency market cap is an indication of how investors feel towards crypto and decentralized assets as a whole. A dip in the overall cryptocurrency market cap is an indication that the entire marketplace is about to dip, and it's often better to just hold assets and refrain from making any trades. Compare this to the total crypto market cap increasing but BTC dominance dropping. It should go without saying that investors are feeling bullish, putting money into crypto and also looking to support the more exciting and radical altcoin offerings, arguably the peak of a bull market cycle. Identifying the state of the market is the first step of any trading strategy. It's key to understand the mentality of investors around the planet before attempting to make any serious commitments or turning to any particular strategy. Thereafter, look to consider the overall trading price on a weekly or monthly scale and start looking to add some performance indicators, and this is where things start to become a lot more technical and far more complicated. But before we get into that, we need to ask, hey, are you liking the video so far? If so, I have good news. Make sure you like and subscribe to No Cap Crypto because we release videos like this every week. Also, comment below and let us know if you have any crypto trading strategies that we should be checking out, and make sure to stay to the end to not miss anything important. Moving averages are one of the most basic and most ideal methods of considering the quality of an asset. When analyzing the movement of an asset, generally stick to longer time frames when looking to make market forecasts. Crypto day traders and intraday traders need to cut through a lot of noise and discrepancies in order to get accurate representations. And these short-term trading strategies are often left to more advanced and more cold-blooded traders. The three primary moving averages you should be looking at range from the 200 days MA, 128 days MA, and 50 days MA. The longer-term moving averages should be a clear supporting indicator to the general trend of the marketplace. The intersections between these indicators can signal a death cross or a golden cross, the moments right before a huge pump or a huge dip. Another common and well-suited combination of indicators is Bollinger Bands and the Relative Strength Index. Combine and overlay these two metrics and they should reveal a good indication of whether assets are being oversold or overbought while relating these two concepts to price and volatility. These indicators should be compared to your percentage gains. This is arguably the most efficient method of investing. Don't look at the overall price of an asset, but rather the percentage increase you've been seeing since initially getting involved. As long as you're beating the bank and long-term interest rates, you're doing a good job. Don't be afraid to pull out some gains in order to offset the initial investment. After seeing some healthy returns, it's important to take a breath and let your money sit. Do not forget that holding crypto without some sort of plan is ill-advised, especially in the long term. It's widely acknowledged that you should switch any funds you aren't actively trading with into some sort of stablecoin, be it Tether, USDC, or even DAI. You don't want to return to your $1,000 of altcoin holdings and find them devalued to nothing after a few weeks. That being said, it's a good habit to keep your ear close to the ground in terms of overall crypto news. Check a collection of various news sources for huge announcements and big strategic partnerships and look to alter your holdings around those. Active investors have seen some insane growth and avoided some unbelievable crashes just because they kept up to date with the freshest news. And you don't get much fresher than no cap crypto. Let us know what you think about today's deep dive into some quality crypto trading strategies in the comments below. Keep in mind, I'm not a financial advisor and that this video exists purely for educational purposes. Please do your own research and make your own intelligent financial decisions. Don't forget to subscribe to the channel so you don't miss out on our next video, and I'll see you in the next one.